All right, guys, welcome to the webinar. Black Label Capital presents Keeping Up with Insurance with Derek Pelkey. Obviously, my name's Jeff Molepske. This is Derek. For those that don't know you, we'll give a quick background of Black Label Capital. We were founded in 2018 after our founding CEO happened to come back from overseas serving in the Marines and ended up liking fixing and flipping houses. He did about 30 of those and then founded Black Label and Capital. 2018 decided that he liked the finance side things of that. And what parallels into what we have today is Derek Pelkey with Goosehead Insurance, also happens to be a Marine veteran. So Derek, if you don't mind talking to us for a minute about your background in the Marines and then how you transitioned into insurance. Take it away.
Definitely. Thank you, Jeff. And thank you, Black Label, for having me today. So a little bit of a background of myself. I had a pretty normal childhood growing up in Boston, Massachusetts. Shortly after the Boston bombing happened, I kind of came to the conclusion that the Marines was the direction I was going to go. So without thinking of anything else, without looking back, I joined the Marines. I did 4 years as an infantry rifleman, or 0311, for those of you who know. And then I got out of the Marine Corps. But while I was in and on my deployments, I kind of started coming to the conclusions of, something about real estate really just struck my interest. And the deeper I looked into it, the deeper I learned all of the benefits that come through real estate, whether it's in the insurance industry that I'm in, lending industry like Black Label Capital, and even some other, different real estate professional industries out there. But my big thing was I knew the Marines was giving me that foundation. It taught me the discipline. It taught me how to work hard. And it taught me to have a pretty big point of view on everything. And I think having a big point of view translates perfectly into the real estate industry with how flexible you have to be.
Thank you for that. And as we jump into this, Derek's kind of going to go through some items and kind of hit the highlights of what's going on in the market. And then later on, we'll discuss kind of some things we see as the lending side of things. As you guys come in, feel free to have any questions that you have. You can put them in the chat box there. Feel free to ask. If it's relevant at the time, maybe we can jump into it. If not, we may have to, answer those at the end. But we'll get those in and feel free to ask away, and we'll go from there. Right.
All right. So to kick things off, I mean, all of us know if you have a car, if you have a home, especially if you're an investor and have a portfolio of homes, the insurance industry is absolutely crazy right now. Everyone's rates are going through the roof, whether it's home, auto. My personal rates have gone through the roof, as I'm sure all of yours have. So obviously there's some reasons behind that. It's not just because insurance companies are trying to make as much money as they can. The prices that they're putting out there is to keep them profitable and keeping them able to continue to insure people. But to dive into a little bit behind that, I think this is a great slide to look at. The past 3 years, just the overwhelming series of negative events have impacted the carrier's abilities to underwrite and ultimately achieve those profits that keep insurance carriers' rates low. The first one, we're going to look back all the way to 2020. You already know what I'm going to mention, the pandemic, COVID. It was crazy. Lockdowns happened, travel halted. A lot of people stayed home. And when a lot of people stay home, obviously the risk level is severely decreased. So when there's not much risk, not many payouts coming from insurance companies, that results in lower premiums. The companies are more profitable. They don't have to have such high rates for those margins. But we moved down the road a year, down to 2021. Life comes back to normal. Those restrictions are now lifted. People are out and about being a little bit crazy because, that newfound freedom per se is back in their life. So there was a sharp spike in claims from that very risk-free level to this now increased level of risk. But premiums were still pretty cheap around that time frame because of the amount of profits carriers did have at that point in time. But now moving down another year, now towards the more economy starting to turn upside down, the inflation side of things in 2022. With inflation, everything gets impacted beyond us, beyond our rates, but things like fuel, labor costs, and material costs, those three things specifically, are three variables that did increase the overall premiums nationwide. But now moving down to last year, 2023, that's when companies like continue to increase their rates to make up for the material costs, make up for the inflation in the market. And that's when a lot of carriers started to figure out they're facing the net losses. And when carriers face net losses, they have a couple options. Either they can shut down their business, continue not to insure anyone from that point forward. They can increase their rates to try to regain their profitability standpoint and become a re-competitive carrier. Or the last thing that we don't hope for, but unfortunately it happens a lot, is the amount of restrictions. Normal carriers that just offer to insure the home now require a home and auto bundle, restrictions like that. But as we're in 2024, quarter two, 2024, now we're starting to see everything stabilize. The massive events that have had payouts in the past are starting to kind of plateau once again. And profitability is continuing to increase for many carriers across the country. And now doing a little bit of foreshadowing for 2025 around this time next year from the way that the trends are going, unless something crazy happens in the back half of 2024, that's when you should start to see the improvement side of the increased rates, or it should start to decrease at that point. The underwriting restrictions will loosen, and carriers are going to want to grow again. So the only way carriers can grow is to offer that incredibly low premium that we're all very waiting to have. That's so good on that. This kind of goes deeper into what I was mentioning as far as material costs. So looking at this map of the United States here, the big thing, Texas, California, Louisiana, Florida, and New York. Those are the most difficult states to write insurance for a variety of reasons. The population itself, I mean, those states alone have 40% of America's population. And where there's a lot of people, there's a lot of risk. Where there's a lot of risk, there's a lot of claims and payouts. With the increased risk, increased payouts, the costs have increased for the materials, for the supply chains, and the labor that goes into rebuilding. So, you know, how much it would cost to build your house 10 years ago is completely different to rebuild that exact same house in today's day and age, just from inflation alone. So obviously, if you live in a state where the risk is increased and the amount of payouts are increased over the national average, like these states, it does become much more difficult to write insurance and have carriers accept them in with minimal restrictions. Here we're good on this slide. And this kind of further goes into the difference in payouts that we've been talking about to this point. So, I mean, we can look back as far as 1980, but I really want to start shifting the focus over towards the 2016 timeframe, that big peak towards the end here. 2014 to 2016, everything was pretty normal in life and the economy. But as we start to creep into the 2018, 2017 timeframe, that's when we see massive spikes in the total cost for payouts. And you see the number at the top of each bar is the number of billion-dollar disasters that occurred in that year. So when you see that 2017 at 19, and 2018 at 16, different billion-dollar plus events, like that's going to increase the rates. Obviously, companies are paying more than they've ever had to pay. And then we really start to focus on the 2020 time frame. And that's when you see the all-time high of 22 different billion-dollar disasters that occurred just in that year alone, and pretty much at the same level for the next couple of years from there. When the levels are that high, record-setting high, it's no different events from any other time frame in this entire series. The only difference is the level of inflation. It's a lot easier to reach $1 billion claim when material costs and labor costs and the overall payout costs are much higher than they used to be. It doesn't say anything about the types of disasters that are happening. It's just much, much easier to reach that $1 billion claim mark. But on this graph, as you can see, last year we did come down to 7 different $1 billion payouts. And with that consistent downtrend over the last 4 years, that's when we start to become more confident that the profitability is coming. The $1 billion disasters are lowering, which ultimately will lead to profitability in the near future. It continues to go a little bit more in depth on the supply chain challenges combined with inflation. As you can just see, like a good one, this dark blue line on the graph here, that was pretty constant up until about July of 21, and then it starts to go up. That's just a shingle cost. So if that alone, everyone needs a roof. If there's a hailstorm, that's the first thing that's taking the brunt of the damage. So it's a pretty important part of your house to have. And when that base necessity starts to increase in price, along with the other things like the construction goods, like just the lumber and wood, compared to the averages, that's why everything has been increasing the way that it has been. So now we're going to dive into kind of what I'm seeing on my side of things as I run quotes, because I do run quotes all over the country, a lot in Texas, but I do run quotes all over the country. So the things that I notice is the range in premiums is significance. You know, obviously Midwest compared to Dallas, Fort Worth, Texas are going to be 2 completely different risk levels. The Midwest price points are a lot cheaper. It's a lot easier to get things out there, and the construction costs, labor costs, all of those things we've already talked about are much, much lower than Texas, and the amount of people in Texas is a lot higher, so a lot more expensive premiums. But the big thing, and I hit on it earlier, is the tightening of underwriting. I'll go back to the home versus home and auto example that I mentioned earlier. Just that's the best example. A lot of carriers are expecting these new packages, whether it's if you're an investor and have multiple different dwelling policies for your multiple different properties that you own. Some carriers will require, if you want one to be with us, all of them have to be with us. Or if it's just on your home, you definitely have to have the auto with the company. And the more increased risk that you become, or the more resistant you become to wanting to accept those new restrictions, that's when carriers these days are just not accepting any significant risk and will just flat out decline coverage at this point to preserve their profits. All right. And this is just a good idea of the best practices to navigate the crazy market. I know we're talking a lot about how crazy it is, but you know, with how crazy it is, I would love to give you a good roadmap on how to navigate it. So starting off, work with an independent agent who can shop the market, aka a broker. There's nothing wrong with captive carriers that you'll see down on point 4 here. There's nothing wrong with them. They just don't have a lot of options. If we were in an industry in a time frame where options weren't really needed because everything was profitable, everything was competitive with one another, that's understandable. But with how crazy it is nowadays, it's important to find as many options that will allow a policy to tailor around your life, rather than you having to tailor your life around a policy. But that brings me into my next point of start the process early. If you're closing on a house, it's better to get the insurance out of the way. Honestly, it's the easiest step in the home closing process, but it can be one of the biggest steps that prevents the process from being a proactive closing. So it's best to get it out of the way early. Sometimes lenders will give you an idea of what to expect for an insurance price, but there's no better person to ask than someone running the quotes for you. And that will give that earlier deadline for your finances and for your possible margins. My big thing, obviously, I like to talk, but I like to educate my clients. And I think if you do have an agent, that you should really take them up on having them educate you, let them do all the dirty work for this market that we're in right now. And it's kind of an experience along that. I get to know who you are. I get to know what is important to you. And I get to start once again, tailoring policies around what's important to you rather than the other way around. But again, point 4, avoid the agencies with limited carrier appointments, the captive carriers. I won't list any by name, but the ones that do target specifically military vets for the best rates, or the ones that you see on commercials. A lot of them do only have that one option. If you have home insurance, they'll give you their version of home insurance and only their version of home insurance. There's no other options. There's no really baseline for you to have an idea of what a good price or a competitive price looks like at that point. And then the 5th one, it does tie in to the bundling or the packaging restrictions that we've been seeing. But I definitely would encourage all of you to shop the entire portfolio rather than, I'm just buying a car, let me shop my car insurance. I'm buying a home, let me just shop my home insurance. Or on an investor side of things, I'm buying this new property to flip or to rent, let me just shop for that. And at points in time, that does become possible. But if you're talking with an agent, especially the first time you're talking with them, it would be wise to shop that entire portfolio because of the difference in the market from this time last year to now.
We had a question of what broker are you with? I think that's a fairly easy one. So Goosehead Insurance, we'll put up his contact information at the end, but that's definitely a good question. Goosehead Insurance, they have a major location here in the Metroplex over in, is it Westlake, Solana?
Yeah, our headquarters is over in Westlake. We have multiple corporate offices around here in Texas, especially in the DFW area. But the good point about Goosehead and having as many options available is we are a brokerage, and we are the largest brokerage in the state of Texas. So if you are looking to shop around in the state of Texas, we do have the most options available at our disposal for you. All right, now we're going to start to tailor into more investor specific insurance related things. The first one is, what type of policies should your non-primary home and autos have? So all of your investment properties, and it really comes down to 2 different ones. The first one is going to be a builder's risk policy. This one's very common for new construction. I'm sure Jeff has had plenty of people need a builder's risk policy for flip situations. Very, very common. There are some pros and cons behind it. We'll go over the pros first here. The first one is the flexibility of having a 6-month option. If you know that that build is only going to take 6 months or less than 6 months, you don't need a year-long policy. You really only need that 6-month option. Then that is designed for you. You're able to customize the dwelling coverage more easily. So if it's a flip situation, you know the value of the dwelling beforehand, and you know the amount of renovations that you are going to put into the dwelling in the renovation process. It allows you to be a lot more flexible with doing so. The cons behind a builder's risk policy: it is non-refundable. Most policies out there, like vacant dwellings, so that we'll cover in a second, are refundable if you do cancel before the end of the term. However, builder's risk, with that 6-month option available, it does not become refundable. And then the big negative con that I would recommend against is a separate liability policy is required. So liability coverage, it's also known as umbrella, which will be covered further in this presentation. But liability is what's going to protect you if someone gets hurt on that property, if things go missing from that property, if anything happens at that property that you are the owner of and you are found to be liable and someone wants to sue you, that is when that liability coverage comes into play, and builder's risk does not offer that within their policies. But moving over to vacant dwelling policies, the pros behind that one is it does have that liability protection included in there. And that can carrier specific. It can vary as low as 300,000. You can get most carriers to give you 500,000, which is the minimum I would personally recommend as an insurance expert. And you can go all the way up to umbrellas, can be written up to millions of dollars. It all depends on your portfolio, your risk aversion level, and what you're comfortable with. And then the cons or another pro of the vacant dwelling is it is refundable. It goes back to that typical insurance policy where if you do say it's a vacant dwelling for 8 months and you paid for a year, you're not just out that 4 months that you paid for. You will get that prorated refund of the 4 months and transition it into either a rental policy, a landlord policy, or a home policy, depending on what you do with it. The cons behind it, they're a year long. There's no way around that. That's just what they are. And with it being a longer duration, they do typically have a higher premium.
All right, so we're gonna see if we can answer some of these questions.
All right, this first one, Derek, great name. Why would insurance companies be incentivized to lower premiums when their cost lower? Would they just maintain their premiums for greater profit? It really all depends. That's a fantastic question. And that really all depends on specific carriers. One of the big carriers that I know right off the top of my head that I write is Progressive. They're very profitable and they're very much in growth mode. Unfortunately, they're one of the few carriers that is in that mindset of profiting and growth right now. But then you have different carriers that are on the flip side of that coin, which is they're not profiting, they're not trying to grow. And the people that they are keeping and giving renewals to, they're just shooting the price through the roof. So the incentive behind different rates increasing is really all dependent on what that company is doing at that point in time and where their finances are at.
So, sorry, I didn't mean to cut you. So Derek has been coming to a lot of our events, and him asking the question reminded me that go ahead and pencil in your calendar if you guys are local to Texas. We're doing a networking event on 6/20. Goosehead and Derek here happen to be a sponsor, but 6/20 includes food, snacks, golf, and then networking with other real estate professionals, insurance realtors, other builders, investors, fix and flippers, and all that sort of thing. But I know Derek's been to a couple of our items, and he always asks where they're at. So it reminded me on that. And then the next question, you see that they're asking about in Illinois. So I'll let you answer that because I don't know what all states Goosehead's licensed in.
Definitely. No, Goosehead is definitely trying to expand right now. But the good thing with you in Illinois is we have a corporate office in Chicago as well. So the Goosehead capabilities are very, very substantial in Illinois specifically. I do believe my contact information is here at the end. I do have multiple teammates up in Illinois, Chicago office that I would love to get you in touch with. If that interests you, feel free to shoot me a text or an email after this.
So we're gonna get going with back to the presentation, but if you guys have other questions, we'll work them in as best as we can, or if we need to kick them to the end, we'll make sure and answer as many as we can. But also, like Derek said, if there's something a little bit more specific that you either want to have a conversation, like we said, we'll have Derek's contact information here shortly, and at the end of it, you feel free, like he said, text, call, email, all the things. And now going to dweller versus home.
Yeah, and this is a good comparison. A lot of people do call me up, whether it's their first time investing or maybe their previous agent didn't give them an educational experience before, to where they're asking me things like, hey, why isn't this on my dwelling policy when it's on my homeowner's policy, and vice versa. So there is a lot of common misconceptions that I hope this slide just kind of eliminates as a whole for you guys in case you have them. So starting off on the dwelling policy. Now, dwelling policy is the term that I chose for it. It does go by many names. It can be a rental policy, which is different than a renter's policy. It can be a landlord policy, anything that basically says someone else owns the building rather than the person who's living in it, and the person who's living in it is renting it. That's what a dwelling policy, long story short, is. The pros behind that one, compared to a homeowner's policy, is it does provide rental income protection. So there's a coverage D on or dwelling policies, and that's called loss of rent. And what that happens, say a home burns down, and obviously as it's being rebuilt or as it doesn't exist, no one's in that home, no one's giving a monthly rent check, where it's supposed to be the exact opposite like it was before the loss. That's when the rental income protection comes into play and provides that loss of rent. And usually that's a specific number, where, you know, some hard money lenders or investors will be like, hey, the rent is $2,000 a month. I will give you a year of rent coverage, which is just that $2,000 times the 12-month. Your coverage D will be $24,000. And there's a lot of flexibility behind that. And some lenders do require a specific amount of rent loss coverage. And then the next pro behind it is the liability coverage as a landlord. When there's a dwelling policy, it will always have liability coverage on it. It's built into it, like I covered in the previous slide. And what that does is it protects your own assets. So that home is obviously an asset in your portfolio. Now your homeowner's policy does have liability coverage built into it. But instead of having to use that or use an umbrella coverage, you can start off at the base level with your liability on the dwelling limit. The cons behind a dwelling policy specific is, oh, I guess I doubled up that point. I guess I really did double up that point. Some cons behind a dwelling coverage is it does have the options to completely exclude personal property. My boss cringes at this example, but the best way to describe what we consider personal property insurance is to take a roof off of your house, flip it upside down. Anything that falls out at that point is considered personal property to us. Obviously, on a home, you have your pots, pans, clothes, all of those types of things. On a dwelling policy, it is very common to not include personal property coverage, mainly because the owner doesn't have many things in there, so there's no need for it. Again, that's a flexible thing that your agent can work with. If you want some coverage or you want more than the usual amount of coverage, that can definitely be a case, but more often than not, it is not included or at a very low limit. Now moving on over to the homeowner policy side of things, it has comprehensive coverage. I mean, everything that you can imagine that can happen to the house is probably covered. Your coverage A, the dwelling limit. So if your home burns all the way down, that's how much the carrier has deemed it would cost to replace it. And that's how much you would get paid in the event of having to replace it up to that amount. Your coverage B is other structures, so it's exactly that. Anything not attached to the main dwelling of the house, your fence, your mailbox, if you have a shed in the backyard or detached garage, all of those things are considered other structures and are covered under coverage B. Coverage C on the homeowner's policy is typically personal property, which we just covered. Coverage D on a homeowner's policy is a little bit different than a dwelling policy. Instead of loss of rent like it is on dwelling, it is now considered loss of use, and it does provide additional expenses when you are unable to inhabit the home that you live in. So things like if you have to get an apartment while your home is being rebuilt, or you're staying at a hotel and eating at restaurants, those types of expenses, that's what's covered under loss of use. Coverage E, the personal liability. We've already covered that one. It's built into homeowners policies. It adds that liability coverage. So, you know, if one of your kids' friends comes over and gets hurt, and their parents want to sue you, that's when that coverage kicks in and protects you. And it also does offer medical payment coverage. The cons behind homeowner policy, it does require it could require the auto insurance to qualify. The good thing is we've talked about that plenty up until this point. But some carriers, especially the bigger, more competitive carriers, they offer huge home and auto bundle discounts. From what I've seen, a home and auto bundle is the biggest discount to exist. But sometimes it doesn't always lead to the most financial sense, and that's why it's important for a broker to shop the market for you rather than just going with that bundle. And then the last con is the insufficient coverage for landlord-specific risks. So obviously your home it's not gonna care about renting out. If it was, it would be a completely different policy. So as someone who has a dwelling or a rental property, having a homeowner's insurance policy on it would not do you well as an investor, especially in the event of a loss. But this last point here, the umbrella insurance, this goes back to liability and something that I do firmly believe in and highly recommend to all investors, especially if you have more than one property. But umbrella insurance provides additional liability coverage beyond the limits of your primary insurance policies, such as a landlord policy, homeowner's policy, or even commercial insurance. And it offers you an extra layer of protection for real estate investors, their portfolios and assets. I know that's a whole bunch of complex wording right there. Long story short, these liability limits that I keep talking about, if you have a $500,000 liability limit on your dwelling policy, and there is a a court case that extends past that, say it results in a $750,000 payout. Your dwelling policy, if you had 500K in liability coverage, it would take care of that first 500K. If you didn't have an umbrella insurance policy, that next 250K is on you one way or another, most likely going to be selling one of those houses that is in your portfolio. Or if you had an umbrella policy, that next 250K would go out of the liability limits for that umbrella policy. And this is kind of wrapping things up on our side of things, but this is the best time to get into the insurance side of things. You throw your offer down, they accept the offer. You're now in your option period. Reach out. Like I said, with me specifically, my contact information, phone number and email is going to be here at the end. It's as easy as sending me a text. Hey, Derek, just closed on this property. This is the address. What can you do for me? And after that, I do all the dirty work from there, and we make insurance the easiest step in that closing process. And open the floor back up for questions.
So here's the curveball question. Wind, hail damage, I feel like, and maybe it's just in the counties surrounding Dallas, but we get hit a lot. I've seen a trend going from 1% coverage to 2%. Is that because they're replacing the roof every 2-3 years, or is there a bigger overlying issue that I'm not seeing?
No, it's a fantastic question. So wind and hail coverage, the new norm of what used to be either a fixed number for that deductible on the wind and hail side of things, or a 1% deductible was the norm, especially in the DFW area. That new norm is becoming 2%. And the further you go down south, especially as you get closer to the coast, that new norm becomes 3 or 4%. And that all ties back into the profitability of the companies. Obviously, if you have to pay a larger deductible to get them to pay out a claim, they're not paying out as much as they would if that deductible was lower like it used to be. Does that answer that question?
Yeah, that's good. And any other questions that come in, in the next couple of seconds we can answer, but as you guys can see, we have Derek's contact information up on the screen. Pretty easy there to get a hold of him. Like he said, text and call there. And then if you have questions for Black Label Capital, our office number is there. You can reach out, and then my email address is there also. But before we go, is there anything that you think that is super important to, most of our clients are going to be investors. Obviously they'll have their primary residence, but most of ours are going to be investors. Is there anything with short-term loans or construction or rehab that you think is important that, kind of geared towards that side of a client?
I would say the biggest thing, especially on the investor side of things, is when you become a real estate investor, you're trying to maximize your profits. The best way to maximize your profits is to pay the least amount for things. So if you do call me up and you do have multiple things like a primary home, primary auto, you know, I am going to want to shop those, just because if I can save you money on those, that increases the margins on your dwelling policy, or on your, you know, many dwelling policies in the portfolio as a whole. So be open-minded to shopping around that first time you contact a new agency, especially if it's a brokerage. And be open-minded to having a broker look at it from a portfolio value rather than just a per policy value.
Perfect. And I don't see any more questions coming in. So if nobody else has other questions, or if it's, like I said earlier, if it's something specific, a little bit more detail or than just a general question, you know, feel free to reach out to either one of us, and you know, Derek can answer any insurance questions. I can answer hopefully most of the lending questions that we have, or if it's something that revolves both of us, shoot us an email and we'll go from there. But appreciate everybody coming on. 2 weeks from now, we will have on 6/5, June 5th, we will have Melissa Berry with her title company, and she'll be presenting on things for investors. The Evite or the Eventbrite will be published shortly. And then, like I mentioned earlier, 620 Pop Stroke if you happen to be local, and glad you guys were able to make it. Thanks.
Thank you.